It's like the Netflix library times 1.5 being posted to the internet on different websites, each month. And so we do that, and we extract those rate data, and then we materialize it in a usable format for NAATP members and others. What we're able to do on parityindex.org is actually take all the codes and provider specialty between mental health and physical health, and then index them against Medicare's benchmarks. That experience really shaped me in terms of what the addiction treatment recovery ecosystem, how it's funded, how the incentives work, how we reimburse for it, and led me to work at Third Horizon and work on these issues around economics and finance.
Welcome back to Mastermind. I'm your host, Mark Scrivner. Our team took the show on the road to NAATP National 2026 to catch up with the leaders, innovators, and voices driving the behavioral health industry forward. We had so many incredible face-to-face sessions on the floor this year, and today we are bringing you one of those dynamic conversations. Let's take a listen. Welcome back to Mastermind. I'm your host, Mark Scrivner, and as always, I'm joined by my fabulous co-host, Jeff Skillen. Jeff, welcome to the show, man.
Hello, Mark. It's great to be here this morning.
Yeah, man. Well, this is going to be another special episode. We're coming to you from sunny Florida today at NAATP National 2026, and today we're joined by Greg Williams with Third Horizon. Greg, welcome to the show, man. It's great to have you.
Thanks for having me. Appreciate it.
Yeah, well, hey, Greg, just to kind of kick off the show, maybe it'd be good to take the audience through your journey and maybe what got you to start Third Horizon.
Well, thanks for having me. It's great to be at NAATP and certainly in Florida. This issue is personal to me. I'm a person in long-term recovery, and my journey started when I was 17 in addiction treatment. And ultimately, my insurance company called my family at 17 years old and said, your insurance is going to kick your son out. And my dad, was able to finagle keeping me there and said, I'll fight them later. But the treatment worked, and I got into recovery and got fired up about recovery as a teenager, turned 18 in rehab. And I went to my dad like 6 months later, and I said, "Did you ever fight that insurance company over, paying the bill for my treatment?" And he's like, "Oh, it's a lot of paperwork and it's hard and all of that." And I said, "Well, you probably should, because it obviously worked." And so my dad signed all the forms, got all the documents. This is back in 2001, no computers and no medical records, things like that. And so he started the appeal process, and he appealed to the insurance company, and he got rejected right away. And then there's a second level of appeal in Connecticut where you go sit in front of a group of insurance executives and tell your story, show them the records. And he's sitting there in front of nurses and doctors at the insurance company and telling the story. I'm like a year into recovery at this point, and everybody in the room knew he was right, and they knew that they should have covered this treatment. But nevertheless, in the mailbox 2 weeks later, there's a rejection letter from the insurance company.
It's like, I think I know how this story goes.
Exactly. But in Connecticut at the time, there was a third level of appeal where you could go to an independent outside board, and it's not inside the insurance company then. And so then he did that, and the outside board, after a month or so, overturned it, and the treatment was approved like a year and a half later. And that experience really, not only my personal recovery, but that experience really shaped me in terms of what the addiction treatment recovery ecosystem, how it's funded, how the incentives work, how we reimburse for it, and led me to work at Third Horizon and work on these issues around economics and finance, and think about, are we doing this right? Are we paying for treatment right? Are we paying for it equitably at parity? All of those things. So that started my core journey on the treatment industry and the finance.
The visual that I get when you tell that story, like you're the Caped Crusader going out to make sure that what's right is right and what's done is done, and make sure that people actually, the payers actually pay the way that they should pay according to the treatment that's needed. Is that fair, or am I like too much of a caricature here?
No, it's absolutely. I learned from people like Carol McDade and Tom Coderre and William Moyers, who were recovery advocates, and they passed the Mental Health Addiction Equity Act in 2008, and it really was this idea that
the brain is part of the body.
The brain is part of the body, but we treated people with mental health and addiction different. And so if we denied cancer treatment, if we denied heart disease treatment at the same rates that we deny mental health and addiction treatment, there would be protests out front of the insurance companies' executive buildings. And that was kind of the basis for the Parity law in 2008.
Well, let's dig into that for just a moment, because I'd be curious. I mean, obviously you're very data focused and you have a lot of research and data to back this up. Give our audience a sense for when you compare the reimbursement rates, the denial rates in our industry versus other traditional, like you mentioned, cancer and things like that. What are those numbers?
It's obviously a state-by-state thing. Every insurance department kind of regulates the insurance at the state level. And so it's a tricky question to answer with specific numbers, but different states, have published reports of 2x, 3x in terms of overturn rates and denial rates. We started an office in Connecticut called the Office of the Healthcare Advocate, specifically for mental health and addiction, because the state, would have to be the payer of last resort for so many people. And because of these insurance denials, what happened when HMOs and insurance companies came on the scene in the 90s and early 2000s around this issue, and we started carving out mental health and addiction as a sort of a separate component of your insurance plan. What it did is essentially cost shift to the public sector.
Right.
Because if you deny treatment long enough, people lose their jobs, they lose their employment, therefore they lose access to their insurance. And that works for families and young adults. And so we cost shifted so many people with these conditions to the public sector through these denials.
Yeah, well, Greg, taking it back to Third Horizon, maybe for those in our audience that don't know about Third Horizon, maybe give us just a breakdown of everything that you all do.
Sure. So we're a proud partner with NAATP in terms of our core focus right now is around helping the provider community see reimbursement rates and reimbursement structures and things that are going on in the addiction treatment field. And so with Third Horizon in recent years, we've started to become a heavy data analytics and market analytics focused firm. So we have deep expertise in behavioral health and addiction, and then we layer that on with data analytics. And so a couple years ago, payers, part of transparency and coverage, payers have to publish something called a machine-readable file. This is a file with
the
JSON file that will crash your computer. So you can Google it today, your insurance company machine-readable file, but do not download the file because your computer will crash.
It will crash. Yes.
I've
experienced that myself. Yeah.
we work with those files and we extract usable insights from those files, and it's every provider with every code for every level of care. So they're enormous file. It's like the Netflix library times 1.5 being posted to the internet on different websites, each month. And so we do that, and we extract those rate data, and then we materialize it in a usable format for NAATP members and others. And so we're doing that across health systems and behavioral health providers. We also do other strategic consulting work with public sector entities and strategy work. So we're an advisory firm, a multifaceted advisory firm.
So visibility and transparency for the NAATP members. I'm curious, it's like you're probably not surprised when you see some of this data, but when some of the NAATP members see this information, what surprises them?
Well, I think the most important part is that there are some providers who do very well, right, with their negotiation and their rates because they're at the upper echelon and, or have had sophisticated individuals negotiating their contracts, or they're large volume providers. What the power of this is, if you're a small provider, now you get to see
Right.
what they're paying in the market, and there isn't any justification. Just like we see price transparency started around hospitals and the notion of like employers getting upset of, why does one of my employee go to this hospital and a knee surgery costs 40 grand over there? Then I have another employee who has the same procedure and it costs 20 grand over here. Like the price variance in healthcare is enormous, and we see that in addiction treatment as well. And so transparency is going to start to normalize reimbursement rates around at least some reasonable.
Is it going to pull the bottom up, or is it going to push the top down?
It may do a little of both,
Okay.
Depending on how far at the top. I think in addiction treatment and mental health, it's going to be hard to push the top down because of some parity stuff I'm sure we'll talk about.
Yep.
So it's going to be really tricky to push the top down. In other things like cancer, heart disease, the top is certainly going to come down and the bottom will come up a little bit. But in addiction treatment, it's mostly going to be pulling the bottom up to the mid-range and then the mid-range up to the upper bounds.
So certainly the benefit to the provider is obvious. How do the payers look at the work that you do? Are they wary of you, receptive of you? What does that look like?
Yeah, I mean, I think that the jury is probably out. I think they're using
Because you're reading their files. I mean, it's not like you're doing anything cloak and dagger. I mean, you're basically just reading the JSON file and putting it in a format people can understand, right?
Yeah, and most payers that we talk to and most people working even at payers, this stuff is so new, and like you have a provider that reaches out to a payer with this data, and most of the contract people at the payers are like, where did you get this? Like, how did you? And then I have to like send the provider.
Everybody says, I know a guy.
Well, no, it's on their website right here. Just send them this link, and
Right.
then they try to download the
it.
JSON file themselves, and they crash their payer computer. But like, so this isn't necessarily widely industry standard. But I think historically the way that this has gone is the payers have had the information,
Right.
and they know what they pay in the market. And they come to a provider and they say, we pay $300 for this level of care. And the provider says, well, it costs us more than $300 to deliver the care. Can we have $500? And the payer comes back and goes, nope, we pay everybody $300. And you're left with either you say yes or you stay out of network and you continue to reduce access to care for individuals that need it who are out of network and have big deductibles. And so that's the dynamic that it's historic. And now the conversation is we pay everybody $300, and then the provider can say, well, no, actually you pay this provider, that provider, and that provider $650.
Right.
Can we have that rate? And then the payer says, okay, we can give you that rate. Like, so the conversation totally changes when there's transparency on both sides. I will say that it also, the payers now see what each other are paying.
Right.
So the payers on their side know, if you're Aetna, what Cigna and United and Blue Cross is paying, and if you're United, you know what the other's paying. So like there's also that transparency on their side. So the rate variance that one payer is paying in a market may be totally different. And so the provider saying, well, I get this from this insurance company, can you match that? Like that conversation changes now with truth and transparency.
So I mean, it's kind of like a Rosetta Stone to really shorten this cat and mouse game that's been going on for literally decades, right?
Yeah, and it's more important now than ever, I think. I mean, I don't know what your out-of-network deductible is, but mine's like 10 grand. And so
You're lucky if it's you, right?
but so if I need to go out of network or my kid needs to go out of network for mental health and addiction, I got to come up with $10,000 on top of on top of the premium that I'm already spending, and it's becoming unaffordable. Where when I think in network, out of network, when Parity passed, I mean the delta between out of network and in network was like $500 or that, but that delta now is we are talking tens of thousands of dollars, And so it's so important now that we find more pathways to get more NAATP members and more addiction treatment providers in network who are providing high quality care. And the only way to do that is to pay them fairly and at costs. But if we don't do that, we're reducing access for millions of Americans, and and that's how we cost shift to the public sector, and that's how people die.
Yeah, Greg, what you talked about some of the larger providers. Like, what can some of the small to mid-sized ones be doing today to make an impact?
Yeah, well, I think that importantly, the national benchmark report is out. We're going to be coming out with some state reporting for initially for California, Florida, Pennsylvania, and Illinois. And so you can access that through NAATP and through our partnership with NAATP. And now you get to see what some of the bigger providers are getting. We're not publishing names in this report, in this data, but we're publishing their rates and which carriers they're getting them from. And so you can now use this information to judge whether or not, can you sustain your business model at an in-network rate? If you got to the upper bound in a market, can you sustain your business model? Because I think what we talk to a lot of providers about, the out-of-network stuff sometimes is still lucrative, and you can still do pretty well. But the challenge is, what does it cost to acquire a patient at an out-of-network rate? And then are you even collecting from the patient their deductible? And you start to model all of those economics, and I'm not sure staying out of network, if you can get to the upper bound of the in-network rates now that you can see them, really makes a lot of sense.
I think about some of the providers that Mark just mentioned, some of the smaller and mid-sized providers that may have gone in-network and not realized that they were at the lower bound, and now all of a sudden they see the delta. What has your experience or history been in terms of people trying to go back and renegotiate an agreement that was already in place?
This is where the jury's still out, and the payers are saying, well, we can't give you more than a 3% increase year over year and a 7% increase.
It's like we're going to lock you in a low rate, and then you're going to, if you're lucky, get a cost of living.
Yeah, and so there's a couple things that potentially you need to consider in that. It does depend on the market somebody's in and the dominance of that payer, and how much of a book of business that payer represents for you. But in some instances, if they're unwilling to budge off this erroneous year-over-year historical benchmark of your rate, even when presented with the facts of what they're paying in the market, in terms of doing a equitable baseline adjustment, then you may have to go out of network for a year, come back. It's like your cable company. New customers get a better deal than existing customers, right? Like, so what do? You switch cable companies for a year, and then you come back and you get a better deal. Mm-hmm. It's in some instances we do have providers who are going to have to do that if the carriers are unwilling to get out of the box of this year over year adjustment methodology, because even in the proposed parity rule, the idea of an erroneous baseline is still erroneous, and so just because the provider never had the data to say that our original baseline was inequitable, doesn't mean that baseline wasn't inequitable, and therefore it should be negotiated on new terms.
How would providers get access to the report for the states that you just mentioned?
So we're going to have a form on the NAATP website to solicit interest, and then if you're watching this, probably anytime second, third week of May, it'll be very accessible through the NAATP website.
Okay, everybody, mark your calendars.
Mm-hmm. Well, and I get that you advocate very heavily for the providers. Are you now on the radar of the payers, and are they starting to lean in more to like work with you?
Yeah, absolutely. We do a lot with payers, often more small community health plans and other things. But we have a number of payers who are looking at some of our data transparency products and Network Navigator. We actually work a lot with commercial agents and brokers, mm-hmm. and so the employer community, the self-funded community, because the employers really do see this idea of a 3 to 5 year trajectory of investment and recovery in a way that, some of our annual underwriting cycles.
Well, they tend to have the subscriber longer.
Right.
Right.
They don't. It doesn't
They're
matter.
not switching cable companies.
Well, they may switch TPAs.
Right.
They may switch Aetna, Cigna, Blue Cross. But if
Right.
I'm the employer, it's still my dollar.
Exactly.
So I care about a 3 to 5 year outcome, and I want to make that investment in my employee or my employee's child because I'm going to be covering their treatment most likely for the long haul.
Right.
And so if I'm a self-funded employer, I care about that. And so we work a lot in the employer community, making sure that the transparency data helps navigate. And where this is going is, for the first time, we can start to triangulate value.
Oh, here we go.
So
he just dropped the word.
So we now have contracted rate data. We can apply that with cost accounting data and utilization metrics, and then you triangulate that with quality metrics, and you actually can get to a value calculation in healthcare for the first time in all conditions. We've never been able to really do this, but that's where it's heading. Is 3, 4, 5 years from now, you're going to go on a website like Kayak, and you're going to look and say, okay, I'd spend, $500 for this treatment at this provider who provides this kind of value, and if I pay $1,200, I'd go to this provider who pays this kind of value. And so it's just like you book the extra legroom seat or the coach seat, and we're gonna get there in healthcare with this data.
All right. Well, you just created smoke. I want to see if there's fire here. Okay. so it's like you just mentioned value-based, right? Okay. I've been doing this for a long time, and we've been talking about value-based pricing being over the horizon, no pun intended. Not you're the third horizon. We were talking about the first horizon, okay? So it's like, over the third horizon, value-based care,
So
you really believe it's going to happen. You really believe it's going to happen, and you really believe this is something that is going to happen in our lifetimes.
We are proving it is happening.
Okay.
So we are publishing in these state
There's some
files
fire. This is good.
case rates. So we don't have all the metrics of what the value-based payment program looks like. But in Pennsylvania, California, Florida, we are publishing case rates that people are getting for ASAM 3.7, case rates for 3.5 residential, and the boundaries of what these files say and don't say. We don't have their contract data that we can see, but these providers are entering into arrangements that are not paid on a fee-for-service, head in a bed per day basis, but they're paid on the basis of an admission, very much like what we're publishing in the data around hospitals. So hospitals get what's called the DRG, case rate payment, and they have been for a couple decades. And for a payer and for a healthcare system in general and an employer, paying per admission with some outcome metrics is a lot more predictable and ultimately sustainable, and you can align the economics in a way that doesn't incentivize the provider to work to get more days for the sake of getting more days, or discharge somebody for 3 days and then they come back and then they get hit for another 28 days, things like that. So some of the failure points in our fee-for-service system through these different alternative payment models. So to get to like a true holistic value-based care model like we advocate for at Third Horizon around the addiction recovery medical home payment model is going to take, we're still pretty far out there, but I think in the next 2 to 3 years we're going to see a lot of especially residential and withdrawal management admissions and probably intensive outpatient admissions being paid for in bundled and case rates.
I mean, I would think that would largely start with the self-insured employers, I would think. I could be wrong. It's like they would have the longer horizon, and they would have the incentive to actually, do a value-based contract. Is that right, or am I not thinking about it correctly?
No, you are. I think they will. I mean, if the carriers and the TPAs, like the BUCA networks,
they actually have the system to do it, right?
Well, yeah. If they're unwilling to write those contracts or the employers will carve out, direct contracts in some instances, and we already have that, where there's a number of providers who serve the labor community or the airlines and things like that. So we have a number of providers here who are already kind of doing those direct contracts with employers. But I think that, carrier network development is, it's complicated. There's thousands and thousands of different healthcare plan products, and carriers would love a provider to be in as many plan products as possible at the same terms. And so I do think there's an incentive on the carrier side where if a self-funded employer says, hey, I want you to do a case rate or an alternative payment model with this provider, that carrier would turn around to that provider and say, okay, we'll do that, but will you, our HMO networks, our PPO networks, our POS networks, will you accept patients across all of those business lines for us? And so usually that can be like a negotiation where you'll, as a provider, maybe accept a little bit of a discount for some of the narrow networks versus, the PPO networks, things like that. But you would think that the paper between a provider and a large carrier network would be fairly inclusive across different insurance design.
So I'm going to put you down as optimistic for value-based care. Now, are you willing to give me a time frame, do you think?
Well, so if folks are familiar with the HCCP LAN framework, which is basically 4 tiers of value-based, tier 1 where we are today is fee-for-service. Tier 2 is sort of, pay for performance or like bonus incentives, and tier 3 is shared savings, and then 4 is fully capitated vertical integration. And so, I think within the next 2 to 3 years, if we're talking about IOP, residential 3.5, withdrawal management, I think the majority of those payments will start to transition to tier 2, bundled payments with a pay for performance during that time frame. I think the shared savings piece, which we really advocate strongly for at Third Horizon, because we believe that the value that's being created by addiction providers or mental health providers is reducing enormous comorbidity costs.
But that's happening in other sectors right now. Take a look at palliative care, for example. There are models out there. Aspire Health comes to mind, where the idea was on the shared savings aspect. It's like it is happening, and you're more knowledgeable than I am.
Yeah, absolutely. So I don't think that because our provider community isn't necessarily capable of kind of owning, in its current configuration, owning a patient across a 12-month span or a 3-year span. It requires, a lot of different network dynamics. I think that we might be closer to the 3 to 5 year horizon before we're seeing some shared savings arrangements where the value that addiction treatment providers are creating is getting shared back with them. And then, I will say that in that same hallway, we're going to see more large health systems, not really providers like NAATP, but we're going to see more large health systems doing fully capitated, full risk models, and focusing on mental health and addiction, because that's where any large health system that's taking full risk now, when they isolate to their mental health substance use cohort, that's where all the opportunity is. It's where all the costs are, but that's where all the opportunity is. And what's fascinating is where people think that mental health and addiction is expensive. It's not that mental health and addiction is expensive. It's that individuals with these conditions have comorbidities that are expensive. And if you manage their mental health and addiction, then you reduce the costs on the comorbidities. And so it's almost increasing utilization on the mental health addiction side and then reducing the physical health. And that's why we're going to see large health systems starting to focus on this population.
Well, but you have to look at the entire individual at that point. So that leads me to parity. It's like I would love to speak to the parity piece, if you don't mind, and I know you're passionate about that. So I looked on your website and I saw that you just recently published some information about Parity. Would you like to share what you've published?
Yeah, we're so glad to have partnered with the Kennedy Forum and the American Medical Association and the American Psychological Association to launch a national mental health parity index. And it's like a really novel use case for taking these transparency files and for the first time being able to provide a carrier kind of specific view of payment rates at Parity. And so for folks that aren't familiar with the mental health parity framework, it says that if your insurance company provides mental health and substance use care, it needs to be equal and at parity to the benefits that they provide on the physical health side. And what that means is it doesn't necessarily mean dollar for dollar, payment rates need to match, but the underlying methodology, the underlying framework, the underlying network reaction, as well as the the co-sharing and the deductibles all need to be equal. And I think since 2008, we've gotten the I call it the front page of the insurance booklet right, where the benefit booklets often do read at parity. But what happens is if they don't have enough mental health and addiction providers in network, then you have this disproportionate access issue where the out-of-network deductibles are so high. If I have a mental health or addiction issue, I need to go out of network for that care, versus if my family's having a baby, largely never out of network, right? And so the cost sharing to the patient and to the beneficiary is far lower to receive physical health care very often than mental health care. And so what we're able to do on parityindex.org is actually take all the codes and provider specialty between mental health and physical health, and then index them against Medicare's benchmarks and compare the percent that a physical health provider is being paid against a mental health provider and show that actual inequity. And then the coolest part is we have a network composition index, and so we can actually map who's in network and who's not in network, which was never really possible before.
That's fantastic.
So we can say, here's because everybody says, oh, there's a workforce shortage, there's not enough providers. True, but we have some providers and we have some supply in the market that's not being utilized by these carriers. And you play the tape through, it's largely because of the reimbursement rates. And so we can demonstrate now through a visualization tool where that network supply exists and in proportion to physical health. And so it's really exciting new opportunities. So take a look at parityindex.org.
Yeah, I've got just a couple quick consulting questions for you. Do you ever get programs that call you to have you help them with providers or with payers where you're helping negotiate the rates? Is that a service you guys do?
Yeah, we're doing a little bit more of it now. And largely it's in the background where we're just supporting, most of the way that these negotiations, go is it's not like you're sitting around a boardroom table and, having a big meeting.
I'm thinking of a number, slide it across the table.
It's not, it's exactly that, but it's over.
Exactly.
It's over email
In
with
months.
3 weeks. Yeah,
In over months,
three weeks in between.
Yeah.
And so we work with providers and we package, the rate data and kind of frameworks for them to use to push the paper across the table and see what the reaction is, from the payer community. So we're doing a little bit more of that now, and it does take some nuance, and it's really helpful to work with the provider directly because you can actually see the underlying contract data, and then you're able to take the same revenue codes, the same HCPCS codes, and then map those identically for that carrier against the peers in the market, and be able to show that. Or from a parity lens, you can map those service levels to another construct in the physical health side to be able to leverage the provider position.
Yeah, and the second question was just knowing all the NAATP members, very well ran programs. What do you what are a couple things that you consult people on of you got to get this right in order to maximize the payment?
Yeah, I think the biggest one is just the willingness and appetite to think differently about in-network rates. We still have so many NAATP members who kind of have survived and sustained in an out-of-network world, and getting them to understand that economic model is heavily shifting, and partly on the consumer demand side, where patients are now looking, they log into their patient portal on their insurance company, and it transparency works two ways. I mean, this is, it blasts like, hey, you go to provider A out of network and it's going to cost you 10 grand. You go to provider B in network, maybe a lower quality provider, but $1,500, and that's right in patients' faces now. And that dynamic is going to push patient demand away from out-of-network, as well as it's also going to put demand on the carriers to have more in-network providers. And so those things in layered on with Parity is going to move the in-network rates up to a place that I think is sustainable. And when you factor in patient steerage and access and in-network volumes, running your facility at 85% or 95% occupancy of in-network folks versus 60% occupancy at an out-of-network, you take that, you factor in the marketing costs, the patient acquisition costs, and you start to get to a place where you could maybe provide more access to your services at a more sustainable, predictable rate, even if on a per patient revenue basis, you're taking a haircut to go in network.
Do you mentioned, because, obviously we know a lot of the providers, and I understand the mentality. One of the things that they tend to say is that this notion of patient steerage, is it really in the payers? Is the incentive aligned for them to actually steer people? And do you think they'll actually put more efforts into patient steerage towards in-network providers?
I mean, absolutely. I mean, it's
I know hypothetically, yes, but it's like a lot of people, they're like, great, we've been in network for a year or two, and it's like, we're just waiting for the payer to actually send people our way, and it just, rarely materializes.
Yeah, I mean, I think that the primary vehicle for patient steerage is benefit design. And so, I think that, payers don't actively solicit phone calls and try to send people to this provider or that provider. But if the incentive is aligned to the patient's incentive through benefit design, then, you get to the steerage piece. I know that for self-funded employer accounts, there's some good EAP and some good, opportunities for in particular, steerage. But yeah, I mean, anybody who doesn't believe that steerage is happening, I'm telling you, if you haven't logged on to your payer portal recently, log on, go look up addiction treatment in your community, and look at what those good faith estimates look like in terms of your facility against other facilities, because it's dramatic now.
Yeah, I think tools such as yours are going to make a big difference in the community in terms of people really understanding the landscape of what's out there.
Well, and the good faith estimate, and so the piece that the No Surprises Act, so transparency and coverage kind of happened right after the No Surprises Act. The No Surprises Act, I mean, every hospital in this country now has to publish their prices, and every provider, hospital provider and even physician office is supposed to provide a good faith estimate of what it's going to cost. And so I think, when you're talking about 30-40% of people's household income, like the sustainability of that, of individuals not asking those questions of how much is this going to cost me, and what is, putting off care, like it, those days are like, it's just too expensive, and it's too much of my household income to not be as judicious as if I'm shopping for a car or a family vacation or anything else I buy in this country. Like, it's too much of my income to not try to shop around.
Yeah. Well, Greg, I feel like your best is ahead already, but as you look back and as you got into this with a mission to really right the wrongs that you and your family went through early on, and you look back at all the impacts you've made, like what are some of the areas you're most proud of to get you to today?
Yeah, it's hard to see the forest through the trees. A lot of work to do yet, and still a lot of problems. But I guess personally, the most salient thing for me is, recovery provided me and treatment, formal addiction treatment, led me on a pathway to recovery, and sustaining my recovery gave me an opportunity to figure out what I like and what I don't like and what I'm passionate about. And, for the past 20 plus years, I've had an opportunity to kind of wake up and work on an issue that I'm passionate about. And I'm so blessed and grateful to be able to work on an issue like this. And, hopefully people like me aren't needed in the near future to advocate.
We're going to keep needing people.
But really proud if most of the work that I do hopefully opens up access to treatment and recovery supports for people I'll probably never meet, but understand that there may be somebody who's receiving a service today that might change the trajectory of their life. And it fills my heart to know that we're working to save lives.
Yeah, well, we appreciate your passion, and we appreciate everything you're doing for the industry. So thank you, and thanks for being a part of the show. Is there anything like maybe that we didn't ask you that you think somebody, the audience, would want to know?
I think that one of the things that we didn't touch on is the continuum of care a little bit. And I think that, from our framework with the Addiction Recovery Medical Home, you can see that on incentivizerecovery.org. It's from a payer standpoint, the more you can offer to a payer or employer about being able to take somebody on a continuum. And I'm not just saying, withdrawal management, inpatient, outpatient, but broader outreach and engagement, outpatient counseling, peer recovery support services, recovery housing services. The more things that we can wrap and provide to the payer community around at least a 12-month horizon, if not a 3 to 5 year horizon, is going to move that value-based thing up. Because, as acute repeated treatment episodes is not the future.
Right.
Sustaining an arc of, we're going to have some expensive early treatments, but then we should follow somebody. And, William White has said this for years, just like in oncology, when somebody has an cancer diagnosis, we follow them aggressively for 5 years until their remission factor drops to the regular population. And so for people who enter substance use disorder treatment or are diagnosed, we should be following these people for 5+ years until their remission factor drops to the general population. And yet we're handing people coins and celebrating graduation after 28 days. And that's not the outcomes that any of us are looking for. So I just encourage people to think as long-term as possible, and the more long-term support services you can wrap around people, or work with community providers in your community to provide additional recovery sorts, the better outcomes and the better sustainable treatment gains we're going to get.
Yeah, well, Greg, I have no doubt that some of our audience is going to want to contact you. So we're going to drop all your information in the show notes in case they do. And it's been a great episode. We appreciate you being a part of the Mastermind community and sharing all your expertise. It's very, very valuable. Great podcast episode. So thank you. And until next week, we'll see you on Mastermind.
That wraps up this episode of Mastermind. Thank you so much for joining us. And remember, Mastermind is not just a podcast, it's a community. So don't forget to comment, subscribe, and review us. Your feedback helps us continue to bring you content that's relevant and relatable. Thanks again to our sponsor, Snapshot, a digital media marketing agency. And thank you for joining us on Mastermind, your behavioral health playbook.